Good morning. I got 8 o'clock, so we'll get going. I see a few people. Ooh, how's that? Hang on a second here. Oh well. I guess you guys will be in the dark here maybe because those backlights, when I turn those on, they just get to be really loud and noisy. So, who won round 5? Any guesses? Any bets? I got one vote for Chester. How'd they do it? They just got lucky, right? Okay, I have I've gone in. I've got to do what's called a restart, and that's going to take place sometime today. I've clicked the buttons, but I think at 4 o'clock this afternoon that should take place. You guys should still be able to go in and look at the reports, as far as I know. I hope so, for round 5. You shouldn't have any problems looking at those, so you can complete the assignment and whatnot that we had for this week, that we'll have for this week. I'm sorry. Let's go back first and take a look at round 4. Take a look at that assignment. Round 4, why can't Andrews sell its high-end product, was question number 1. And I've gone through, I've kind of looked at people's answers. I think I've put some draft comments in for everybody. I don't think you guys can see those. I just haven't assigned scores yet or published those. I kind of like to do that, read through and see how everybody, because every now and then I'll figure out that somebody comes up with an answer that's a right answer that I missed. Every now and then that happens. Actually, far more than I would like to admit. So it's high-end product for Andrews. When we come and take a look at it, is product, what's it called? Atom, right? Okay. You know, whenever I'm wondering about why a product can't sell, what's the first things I'm going to go look at? No. The customer buying criteria. I mean, it's kind of black and white when we take a look at some of this stuff. So we come and we look at the customer buying criteria and we say, ooh, you got to be in the ideal position, right? Where's Adam? You know, I can look at the perceptual map and I can see, well, sure as heck is not in the ideal position. And I can come down and I can actually look. I mean, here's a performance, you know, Fist and Fox are way the heck up here, right? But 11.6, 10.7, you know, you get for Sid, which is back a little bit. But, you know, the ideal, it even tells me, is 11.6 and 6.8. And I'm at 7.2 and 10.8. So I've almost got my performance and my size flopped. And I'm way the heck back here. So the number one reason it's not selling is that it's not even really positioned as a high-end product. What's the second thing that we look at in the customer buying criteria? Age. Okay, and it wants to be as close to 0 as possible. How old is Adam? 4.72. You know, look at the rest of them in that category. None of them are over 2. I'm surprised that they were able to sell 40 of those. Okay, I'm just shocked that they could even sell 40 of them when, you know, everybody else didn't run out. You know, sometimes that happens. Everybody else will run out, but there was still some inventory there for Fist and Sid and Dixie. So the fact that they sold 40 is just shocking. Okay, third thing is reliability, MTBF. Would that have made a difference? I put it on mine. What is their MTBF? It's at 23. Okay, the range is 20 to 25. What's your guide say about MTBF? Oh, okay, you might want to go read that. There's some important information in there about where you could be on your MTBF and still be okay, but maybe a little off the top, right? Okay, you guys might want to look that up because it can it can save you a little bit of money and not cost you on the sales side. So how's that? Okay, lastly, I added this, and this is maybe a little extra, but it's priced outside the allowable range for a traditional product. So actually where Adam sat was in the traditional deal. If you look at the larger perceptual map, you'll see that Adam's sitting nicely in the traditional segment, right? Okay, but the problem is, oops. The problem is when we look at Adam, it's priced at $36, and in the traditional segment, the maximum price here is $28. But I think if you look at your guide, is $28 the actual maximum price that you could sell at? No, your guide will give you some guidance. Yeah, that's why they call it a guide. Okay, as to, there's actually outside of this range some price limit where things might still sell. Okay, they certainly wouldn't be given priority, but they might still sell. And I can tell you Adam is outside of that, right? I mean, 28's and they're at 36, is that what I said? Okay, so they're like $8, you know, over the maximum, okay? So, lots of reasons why Adam didn't sell. What explains the difference in contribution margin between acre and ebb? Don't just tell me that, for example, material costs are lower, right? We can look up material costs and sure they're lower, but tell me why. First, the easy one. Two things that affect contribution margin, right? Price is one, variable cost is the other. Okay, so break it down. Price, variable cost. Look at price first. Ebb's 50 cents higher. Okay, that's meaningful, right? As you'll find maybe as we get to the end of this game, okay, especially when we get to around 6, 7, and 8, if it's kind of close, you know, 10 cents here, you know, 25 cents there, those types of things can maybe make a huge difference. You know, if we're selling 4 million of something, you know, and you can get an extra 2 bits, okay, if you can work that, right, that's an extra $1 million, bottom line, okay, and it also contributes, then obviously it raises your contribution margin, and so in this case 50 cents, right, and 50 cents becomes significant. What's that, about 3% maybe on the contribution margin, somewhere's in there? I'm just looking at the top of my head. Then I broke it down and I said, well, there's 2 variable costs, and I missed one here, but I think my miss is okay. I mean, I didn't put it in here, and that's okay because it didn't contribute, but somebody had put it in theirs and it made me think about it. So their material costs. How about this one? Ebb has a much lower MTBF. Now, are these in the low end category? Yep. So let's go take a look at that. So Ebb is up here. It's the #1 seller. It's got an MTBF of 12,000, and Acre has an MTBF of 15,000. Are those the two that I'm comparing? Yep. Okay. What's it tell you in your guide? What's it tell you first in the customer buying criteria? Is that a big deal? You know, obviously not, right? Ebb was the biggest seller, and it's right there dead bottom in the MTBF. Bless you. Okay. And so for this, I was talking about it in the other segment. Was it important in the other segment? It kind of was, wasn't it? But in this segment, is it important? Yeah, not so much, right? And yet, does that difference there in MTBF, can that make a difference in your material costs? The answer is yeah. You might want to go take a look at what the value of that is. Okay. The other thing in the material costs is that Ebb is older, which means that it uses less expensive materials. So Ebb has an age here that's 8.6. Again, it's actually a little bit beyond, a little bit older, okay, than what you wanted, but it's still as close to the desired age as Acre. But the fact that it's a little bit older actually means that your material costs will be a little less too, right? Because you're using a little older materials in. Right, you're getting stuff that's been around for a while that you can plug in there. Okay. On the variable side, or on the labor side, I'm sorry. On the labor side, we've got automation. We got to go up here to look at automation. Ebb's automation rating is 8, and Acres automation rating is 6.7. So they're both, they've both brought them up. Okay, how much difference does that make? Anybody know? What's 1 point of automation due to labor costs? Anybody know? Okay, it's in the guide. How about TQM? Got to go all the way to the bottom and get to TQM. Only a little bit, but Erie's invested. They should be getting a 1.6% reduction, whereas Andrew's getting 0. Okay, so a little bit, just on the margin, but still some. And then Acre actually makes up a bit due to HR. So Andrews had actually invested some in HR, and so they made up a little bit on the labor cost. Where do I look at how do I tell the difference? Let's go take a look. I mean, and what the actual cost is per item. Okay, labor is this row, and so labor's this row. So Acres labor cost is 6.09. Ebbs is 5.12, so they're saving just about $1 a unit. Okay, just about $1 per unit. I should have looked at overtime too. I didn't. Yeah, Andrews actually makes up a little bit too because they've got a little less overtime. And so because of that, Ebbs should actually be a little bit higher. So you can see that Ebbs' investments in both TQM and automation more than offset their usage of overtime, right? It significantly more than offset, right, their use of overtime. Okay, so that's a pretty big deal when you guys are making these decisions moving on. So the one that I didn't talk about that could be in a question like this that you got to pay a little bit of attention to is carrying costs. Okay. And I know that I often say I don't worry about the absolute variable cost amount, and I don't really typically, but there are times when Acre had 0 inventory, right? Ebb has 376 still in inventory. Again, because they have some in inventory, they would have some variable cost that would be attributed to carrying cost. And yet they were able to, again, more than offset that with their investments in automation. So actually, that's another case that would have actually increased the cost for Ebb, but they've offset that with investment. So, okay. Onward, 3 in the size segment. Boy, everybody struggled with this one. Okay, everybody struggled with this one. And this is one that I'm sure there's one for this next one. So pay attention, please. Okay, pay attention so we can kind of walk through how we do some calculations. A couple of people got kind of close. They weren't quite as specific as I would have liked. Okay, so I'm going to walk you through it. In the size segment, how much money did Digby leave on the table just in terms of sales dollars? So I didn't ask you to break it down for before tax profit or after tax profit, which might be coming, though, down the line. So, and I said that extra credit for calculating the profit left on the table before tax and or after tax. Show your work. And nobody got the extra credit. So, A, Digby had a potential of 34%, but an actual of only 21.5%. That's just kind of a starter. Okay, so I know that they gave up, what's that, 12.5%? Okay, they gave up 12.5% in terms of that. What some people did, and this got them pretty close, was they took that 12.5% and got them really close actually, times the total demand of 4,068 units, right? So that's about 500,000 units, and they multiplied that by 32, either 99 or 89. The problem was you had two different ones here, and they're 10 cents difference. Okay, and so, but you take it times about 33, right? And 500,000 units, and that would take you to 16.5 million. Okay, that gets you pretty close. Okay, but as you can see, it's not quite exact. And why is that? Because Digby had 2 products in that segment, and it breaks it down for you. So I've got Ding left 4.4% on the table, Dune left 8.4% on the table. Okay.
How do you figure that part out?
Let's go take a look. It's a good question. Okay, the actual versus the potential. Should get rid of that. Those numbers, oops, I went too far, I'm sorry. Show up right in here. Okay, so ding, this one's actual, this one over here is potential. Okay, so ding had actual sales of 2.4% and had potential of 6.6. I've got a misprint in here. Hopefully, because that should be 4.2%. So I may be a little bit off on my calculation. Shame on me, right? Okay, everybody see where I made my mistake? So its potential was 6.6. Its actual was 2.4. So there should be only 4.2%.
So you just subtracted those two.
Yep, just subtract those two.
Okay.
Okay. And I do have an error, so I've got mine's a little bit high. I'll have to recalculate that then. Okay. Then Dune is the other one. Yeah. Yep. Dune then is 19% was the actual, 27.4 was the potential, so 8.4% then. Okay. 8.4% would be mine, and that one I've got correct. Okay. Somebody do the math for me. What's 0.042 times 4,068 times $32.89? I'll bring up my calculator here and do it. So 0.042 times 4068 times 32.89 equals 5619, so I got to change that. Okay, and then I got to add that to my 11,273 plus 11,273 equals, so 16,892 should have been my answer. Sorry, I screwed that up. And that's why I ask you to show your work, though. Okay, same thing, because I made a little clerical error there. Boom, if I see that, I'm not going to deduct near as much as I would, you know, if you just put a number down there. You know, you put a number down there that's 15 million or something. Well, it's kind of in the ballpark, but I have no idea where they got that. So, okay. I mean, even if you were close. Okay, so it's a little painstaking, and you know, had these been the same price, it wouldn't have mattered, right? Had they been the same price, it wouldn't have mattered. And they're only 10 cents off, so it didn't make a big deal. You know, for those of you that did the 12.5, you can see here the rounding, you know, that's why I knew I made a mistake there. The rounding here is 12.6, and we were 12.5 when we did the overall, because there must have been some rounding in there or something. That makes a little difference than two, but not a bunch. So, yeah. Okay, so again, go through it painstakingly. Now, let's talk about how would I calculate the profit? How would I calculate the profit that I left on the table? Okay, let's go take a look, because I think I might have even asked one of those this next. Let me come here. I can come up here to my production. And I'm Dune and Ding, right? Okay. My costs are on the material side 1161 and 813, and here it's 1114 and 1007. Okay. I used to use the contribution margin, and that seemed relatively simple. But I had a student last semester that kind of pointed out to me, did a little bit of math, and got me thinking. The problem with the contribution margin here is it kind of takes into consideration some inventory we might have had left over from the last round. And so on a marginal basis, I need to use this, because this is for my last product that got made. Okay, for my last product that got made, this is what my costs were per unit. Okay. So my prices, I know I've got those on my other worksheet, but these are my costs per unit. So, for Dune, my costs are, let's just do the addition here, I'm sorry. Clear. Dune, it's 1161 plus 813. So $19.74, and I could have sold, oops, I should have calculated that and had that in here, it would have been easier. My .042 times my 4068, so what's that, 160,000, 160 some thousand units there that I could have sold. Somebody want to do that math for me? Because I don't know how to use the memory thing here. So .042 times 4068. 170.856. So times 170.856 equals. This is what my costs would have been then. 3,372,697. Okay. My sales were 5,619,000, and I could round it off. That's fine. If you wanted to do 3,373, okay. And then I just subtract those, and then I have my before-tax profit.
So you subtract the 33 million from the 5?
Yep, I subtract the 3.373 million from the 5.619 million. Right. I'll go ahead and do that. So minus 5,619, but I got to go 0, 0, 0, say. Okay. So I had a 2,246,302, or 2,246,000, right? Would have been my before-tax profit, right? My before-tax profit. What's my tax rate? You guys remember from the assignment last time? My tax rate's 35%, so I'd have to pay that to Uncle Sam. Uncle Sugar would get 35% of that amount, or 770,000, something like that. I'm going to do a shortcut. Normally I'd take that times the 35%, and I'd come up with 770,000, somewhere in that neighborhood, and then I could subtract it from that. I can do the shortcut and take it times 65% then, right? The inverse. So my after-tax profit for just Ding, right, would have been $1,004,600, and that would be just Ding. Okay. I'd have to do that exercise again for Dune and go through what my marginal costs are. And it might be a good example of what I was talking about.
That's your after-tax?
Yeah.
Okay.
Yep, the $1,460,000, yep, would have been my after-tax profit, just on that one product. Okay, that's what I gave up. And that was for, was that for Dune, or? No, that was for Ding. Dune, it looks like, might be about twice that, but I'd have to go back and look at those. So that was Ding. Oh, you know what? I used the wrong, God darn it. I had them upside down, so I used the wrong numbers. Shame on me, right? I flopped them. Ding was down below here, so okay. Here's a case in point and why we use these numbers instead of the contribution margin. You can see they both had the same contribution margin. Their prices are almost identical. 10 cents is not that significant, but look at the difference in my costs here. Okay, so that's on a marginal basis. So one of these probably had some inventory left over that was made cheaper, and so it actually helped out a little bit. Or maybe it was made more expensive. I don't know. We'd have to go back and look at last round and see. So, okay, so I flopped my numbers, so I made a mistake. Okay, everybody see where my mistake was? Shame on me. cost that I came up with should have been for should have been for Dune, and I applied it to Ding. Everybody see where I made my mistake? Do you want me to run back through it? Okay. Okay, sorry about that. I know that can lead to confusion, and I don't mean it to. So, okay. Hopefully you got the process. Okay. Yeah, it's a little bit painstaking. Set it up on a spreadsheet. Works pretty good. Then you see it, you label it, you put it on there, you remember those types of things, right? Instead of doing like I did, I just made a mistake, partly because I'm going back and forth and just trying to use the calculator and doing those things. Had I set it up on a spreadsheet, it would have made a lot more sense. The gal I said last semester that taught me some errors of my ways, she had it, when she submitted it, it was on a spreadsheet, and I looked at it and said, I've been screwing up, okay? Because she had it there and it was all pretty easy to see, right? Using the marginal cost versus the overall cost. What team will win the final practice round? Well, now we know, of course, what team won the final practice round. And I think we know. I haven't shown you the spreadsheet, though. Okay. There weren't too many correct guesses, I don't think, on that. And that one, by the way, I'm not going to count that one. I might give, if you got it right, I might give you a little bonus pop, kind of, but I'm not going to count that one in the score. I won't count that against you because that was meant to just be a guess. So, okay. All right. Now let's go take a look then. You want to see who won? I'm going to hang on here. I want to go up and go to round 5, so I'm ready. Yeah, so after about 4 o'clock this afternoon, I think you should be able to go in if you want to get started. You wouldn't be able to this morning, but you could get started on your next round's decisions. We start all over too, right? Everybody gets a blank sheet. We start just exactly like we did at the start of the practice round. So none of what you have done for the practice rounds matters now, right? We get to start with blank sheets. So no matter how well or poorly you might have done, okay? Okay, so let's see who won. Do you think our winning student team beat the computer? No, Bobby's shaking her head, so we'll see. Okay, earnings per share was Erie, in fact, the computer team, one of the computer teams. But in second place was Chester, so not bad there. ROE, though, Chester came back and whipped up on Erie a little bit there. Okay, so what's that tell you? Erie had higher earnings per share, but Chester had higher ROE. Could be that Erie has some more shares outstanding and has higher equity, right? And Chester has a little lower equity, and so they, okay. We'd have to look at, if we look at profits, we might know that. Digby had the highest contribution margin. They had a big contribution margin. We'll take a look at that. Stock price, Chester had the biggest increased stock price, a nice bump up in stock price. Erie did have a higher profit, okay, and they did have the highest earnings per share, so their earnings per share might not be too bad. But Chester came back and had the better ROE, and so that tells you then that Chester just has lower equity, right? It has lower equity, and that's what caused it to have a higher ROE, right? So you always got to remember when you're shooting for a couple things here, ROE is one of the big, and as is earnings per share. There's a numerator and a denominator, okay? And in both cases there, you want the numerator to be bigger, but if you can make the denominator smaller, that works out nice too, right? Because that increases. So your denominator, for ROE is your equity. If you can make your equity smaller, it makes your ROE bigger. Okay, your denominator for earnings per share is shares, right? So if you can make your share number smaller, it makes your earnings per share bigger. Okay, we tend to concentrate on the numerators. Okay, and so this is just a little hint going forward. We tend to concentrate on the numerators. We're always trying to make our return, our net income higher, Okay, and we're always trying to make our earnings higher, similar things, net income and earnings, but sometimes we forget that there's a denominator too there. Okay, and a good financial manager doesn't ever forget that, right? Cash flow, Chester did well. Strategy, okay. Oh, look at that, 94.5 to 93. So pretty close. Did Erie have any deductions by chance that might have allowed Chester? Chester's far and away leading. Yeah, in fact, nobody could catch them even if they had all three deductions, right? And they didn't, but Erie didn't have any deductions, so only Andrews and Baldwin ended up with some deductions. So that was fairly impressive. Okay, a few things to look at. So after round 5, where are we at here? Again, the ROE, Chester 22.9, fairly impressive. I'm going to predict by the end of round 8 in the competitive rounds, we'll see maybe some 30 and 40%. Okay, I can be completely wrong on that. Sometimes teams get it figured out so much that they're just competing so harshly that it becomes difficult. Okay, so while I say that, that's been my typical experience, is that teams figure it out and it's usually very positive things. But every now and then we'll get some great clash going, and the competition gets so difficult that it tends to keep some of these numbers down. Okay. Sales, look at that. Chester and Digby almost identical in sales, right? Just a couple million difference, which at that level is pretty minor. Ferris, huge sales, but Ferris didn't score that well, right? They didn't score that well. Erie, good sales, not that much ahead of Chester and Digby, right? Just a little bit ahead of them. Huge difference here. I glanced down and looked at the contribution margin. Look at that. Digby had a 44.1% contribution margin. That's pretty good after round 5. Okay, that's not too bad after round 5. I tell you that we'll probably see you guys improving on that again, round 6, 7, and 8 especially. Right? You'll figure out cost containment a little bit more, but competition on the price, who knows? What that could do, but you guys will figure out some of the other things. 40% for Erie. Amazingly, Chester was just right at that 30%, so relatively low. In fact, one of your questions might be for this week is, how could that be? Look at that, almost identical sales. Okay, a 14% difference on $200 million in sales. That's a $28 million difference in gross profit. That Digby would have had $28 million more in gross profit that Digby would have had over Chester. Okay, but Chester ended up having $8 million more in profits. Wow, what happened there? So a $36 million swing from looking at the contribution margin and comparing it to sales. We had a $36 million swing. That's pretty impressive. Okay, that's going to be one of your questions. What caused that? Okay, how could Digby have such a much higher contribution margin, okay, and yet make less money, significantly less money than Chester? Where would you look? Where are you going to find the answer to that? What's it relate to? Net income. So it's going to be on your income statement. And it's all going to be on the income statement. Okay? It's all going to be right there. Okay? And the income statement's only about 8-9 lines. Okay? Just make sure that you get every one of them that fits. Okay? Just make sure you get all of those. Okay? Be complete when you look at something like that. Okay. Other groups in here. Baldwin's still struggling with sales. Andrew struggled with sales too. So we're seeing, quite a bit of tilt over here to the right-hand side. Right, we got the 4 teams on the right-hand side that have done really well in sales, and Andrews and Baldwin kind of struggled. Andrew struggled mightily with contribution margin as well. Okay, Baldwin still had decent contribution margin, but Andrews really struggled there. So, okay. Stock market. Andrews is the only team, though, that throughout the whole thing did not sell any shares. This is extremely unusual. Okay, that every team either has the same number of shares that they started with or more. Okay, usually teams have heeded my exhortations, and we'll see teams that have far less shares than what they started with. Okay. Money management becomes a bigger deal when we get through 8 rounds, and I'll show you that when we get down to the income statement, what I mean by that. Erie won, borrowed lots of money. Okay, so leveraging isn't necessarily a bad thing. Lots of money, right? Okay, Chester took second place, didn't borrow hardly any money. In fact, paid a bunch back, right? Has very little outstanding. AAA rating. Mikkel was asking me about that. What's that mean? That's your bond rating. Okay. Remember that there's bond rating agencies, S&P, Fitch, and Moody's do bond ratings. Okay. This is, I don't know if they tell us who does our S&P rating. Okay. So this is saying that we think that Chester would be a great investment grade bond. Okay. AAA. The United States government's not AAA. We got downgraded by S&P here a couple of years ago. And the United States government's still considered the strong, the safe haven in the world usually, but the United States government's only AA minus or something like that, or AA plus, right? It's one notch below AAA. Okay, there's only 3 or 4 companies in the whole world that are big companies that are rated AAA. Okay, Apple might be one. I don't know. I'd have to look and see. Apple doesn't borrow a lot of money. Apple, this is strange. In Switzerland, no, it wasn't Apple, but in Switzerland, the government of Switzerland right now, interest rates went negative. In other words, Switzerland can borrow money from people, and people are paying Switzerland for the privilege of lending it money, if that makes any sense. Believe me, it doesn't make any sense. This doesn't happen very often in the world. This is kind of a strange time. When you see interest rates go negative, Switzerland's a very strong nation financially and whatnot, and so I can understand why it's Switzerland, but I can't understand why that's happened. So, okay, so is that meaningful? I told Mikkel, I said, in this game, if I was AAA, I don't think I'd want to be AAA. I think I'd rather be triple B. Okay, and part of that reason, the reason Chester's AAA is when you look at this, they have almost no debt, and when we go down a little further, you're going to see they have lots of cash on hand. Okay, so your best credit risks are always, we say in the bank, you always want to lend money to people that don't need to borrow it, right? Those are your best credit risks. Okay, and that's kind of where Chester's at. Right, they don't need to borrow any money, so they're really great credit risk because they could finance it themselves. So if they came in to borrow some money, wonderful. But cash flows, okay. Let's see what's going on here. We got depreciation numbers all over the board. That's interesting. Accounts payable, no big deal. Inventories, we see some changes there. Chester was able to get rid of some inventory that they had from last round, obviously, so it helped their cash flow. Look at that. A lot of teams, especially your 2 computer teams, right? They're not playing end game. They didn't know the game was going to end after 5 rounds. So they went ahead and invested just a ton of money into plant improvements. And I would add that Digby did the same. Okay, Digby made a huge investment in plant improvements. So, as a competitor, I'm saying, well, maybe Digby didn't play end game here, and so I might be a little bit concerned about what they might continue to do in the future. And on the other hand, Chester obviously went this way, right? Okay, they sold some capacity. Okay, I would say that that's maybe a bit of an end game play because they knew it's the last round, right? So you sell some capacity, you generate some cash. That's okay. Maybe you did it anyways. Who knows? Maybe it's because of a reinvestment someplace else. Digby and Erie and Ferris, Digby especially, continue to sell stock. They have twice as many shares outstanding, right? Go up and look, they got 4 million shares outstanding, twice as many as what we started with. What's that do just on their earnings per share? It cuts it in half then from where we started, right? Okay, it cuts it in half from where we started, okay, in terms of the number of shares outstanding. That's pretty difficult. They have to make twice as much right? Digby has to make twice as much money in order to have the same earnings per share as a team that still just has 2 million shares outstanding. Okay, so that's a huge deal. It also contributes to their equity, though, doesn't it? I mean, they've sold 2 million shares, and all that money goes to equity. You know, obviously they've invested in some things, and they might have depreciated and this and that. But for the most part, that's 2 million shares, and how much they've gotten for those shares, I don't know. But 2 million shares, that's gone into equity. So we'll take a look at their equity and see what's going on there. Had a lot of teams that retire some current debt. Retire debt from the prior round, current debt. Cash, 53, 43, Chester, $52 million in cash. That's a lot of cash. Okay, so again, you'll find as the game goes on, there's still a lot of places, because nobody was really bold, there's still a lot of places that Chester could invest that money. Lots and lots. You know, they could have gone huge TQM. They didn't. Okay, this round. They could have invested more in plant automation. They could have done a lot more things to invest. So they could get rid of that cash easily without having to pay dividends or buy back stock. You know, there might be other places they'd want to invest that. But that kind of cash management is going to become more important as we get into the competitive rounds, especially from the mid rounds on. Okay. Accounts receivable, inventory, you know, nice low inventory number for Chester. Chester obviously did really good. Erie did too in managing their inventory. Those are wonderful numbers. Plant and equipment, look at the difference. Okay, so Digby sold a lot of stock. Digby has plant and equipment of $232 million, $258 for Erie, and $250 for Ferris. Chester has the least plant and equipment. The least. So part of that is because they sold a little bit this last round to generate some cash. But all along, they didn't really increase their plant and equipment. And they had, keep in mind, they had the exact same sales as Digby, right? They were just about identical. So talk about ROA, right? Or RO whatever, plant and equipment. Okay, they're generating $200 million in sales with $100 million in plant and equipment. They're generating $200 million in sales with $232 million in plant and equipment. Which one's more efficient? Like, duh, right? Chester. Way more efficient, way more effective, way more cost. Okay, way more cost effective. Okay, so total fixed assets. Look at that, 37, by far the least. Okay, because you took depreciation out of there. $37 million in terms of total fixed assets. I would argue that the only reason, in fact, that Chester has a lot of total assets, look at that, is because they got a ton of cash. Their total assets would have been about $60 million had it not been, you know, if they got rid of all the cash. Okay? Think what that would have done to their ROA. Think what that would have done to their ROE. Right? Their ROE would have just about doubled. If they pay, you know, this is just a really hypothetical thing. You wouldn't want to do this because, like I said, there's probably other places they could invest their money. But let's say they had paid out a dividend of $52.6 million. Okay, stockholders are happy. They get a dividend, right? And all of a sudden, Chester has total assets of $65 million. Their ROE would have nearly doubled. Okay, it would have just gone through the roof. Wouldn't have affected anything else, really. Wouldn't have affected their earnings per share. Okay. They could have used this money to buy back stock instead of paying a dividend, and then it would have had a very positive impact on their earnings per share. They might have easily won the earnings per share, right? Because they could have bought back a lot of stock. I think you're limited as to how much they'll let you buy back, but they could have spent a lot of this on buying back stock and the rest of it in dividend, maybe. Now, did they know they were going to end up with $53 million? Maybe not. I don't know what their projections would have been, but okay. We look at some of these things down here. You know, common stock. Again, look at $74 million in common stock, 62 for Ferris, 43. Andrews has got the least. That's what you started with, I believe. Okay. Total equity, $92 million. Again, think about that. They could have got rid of $52 million in cash. Their total equity actually would have been $40 million. Their ROE would have even actually more than doubled. ROE would have gone from whatever it was, 20% to 45%, something like that. Okay. That's getting a little risky, probably. So I'm not telling you that this is what you want to do. I'm giving you the extreme examples and giving you a hypothetical example, right, of what you could do. Okay, so and what that would do to the scorekeeping. Sales again, income statement. You know, I told you that you're going to have one question that's going to compare Chester and Digby. I'm not going to belabor that a little bit, but your answers are probably going to be down in here, right? One thing that's interesting was this: other fees, write-offs, TQM, and bonuses. Both Baldwin and Chester actually had a negative number there. What's a negative number here mean? These are expenses. So we actually have a negative expense. So that means it's a positive. Yeah, they actually it might be one of my questions. Might be my bonus question. I'm not sure on the assignment. So we'll see. And you guys don't even have to do the assignment. So we'll give them all the answers. Okay, so be thinking about that. Yeah, where might that have come from? Okay, and it's one thing. I mean, there might be an answer, but you could actually take the answer a little bit further too. Okay, and think about it a little bit. Okay, so do some comparisons down here. Again, Chester ended up again a $36 million flop from here, because you can see the the variable costs. And again, don't tell me that the variable costs were way less for Digby, okay? Because that's all incorporated in the contribution margin. So when I ask you a question about contribution margin, I've already asked you, I've already incorporated the variable cost in there. That's why I want to get past that. But again, you see there's a $30 million difference there. Digby should have been that much better, but we flopped, okay? And it became hugely in favor the other way. So still here we are at the end of round 5, and there is still so much capacity in the entire industry. Huge capacity in the entire industry. It's unused capacity sitting out there, mothballs, it's got mice running around in it, things like that, because we're really not using it as we could, okay, as an industry. See some of the inventories. I see Adam, you finally got repositioned as a traditional product, and it sold a little bit better, so they did a little better. They got the price down. I think that's still, isn't that still 50 cents outside of the... Yeah, so $27.50. So yeah, it's 50 cents high, so it's no wonder it didn't sell real well, because they're still at the very high end. And it's still an old product, right? And we want that product to be. Here's a little hint too when you're doing that, because Adam came maybe from the high end and it went into the traditional end, okay? And they like the positioning of it. That's you get that life cycle thing going on, right, where you're letting something drift back, and you like the positioning of it. But age becomes important on that traditional product, so you got to tweak it sometimes, just a little bit, and that lowers the age. It makes it look like a new product. But you don't want to spend a lot on R&D, but you just tweak that a little bit, and it's going to lower the age dramatically, okay, and still be in that kind of position that you like. So maybe you change by 1/10, on the performance and 1/10 on the size, right? Okay, so you got to mess around with that a little bit, and you got to do some tweaks and those types of things. Now, on the other hand, it had low MTBF as a high-end product. It's probably way on the high side here as a traditional product. Chester, we said, didn't have a lot of inventory. Digby, not too bad. They got a bunch in the high end. Erie, look at that, man, all in the low end trad, but they've just been selling like crazy, just in the low end traditional in terms of the numbers. Huge market shares, right? And then Ferris introducing even one more new product, so interesting. Now, both of these spent a lot of money. It doesn't look like Erie's spending any money on new products, but they spent a lot of money on plant improvements. What do you suppose they did? They're probably still bumping up capacity, and I wouldn't doubt that they've spent even more money here, right, trying to contain costs, spending it on the automation side. You're going to have another question here. I'm going to scroll down. I didn't ask it about Andrews in the low end, but Andrews gave up a lot there, right? 22, and they could have sold about 32. So they gave about 10% of the low end market that they could have sold. So, you know, rough math, they could have sold another 1.6 million at 20 bucks. You know, $32 million in sales maybe. Huge, right? Huge, huge. And that maybe they didn't have the capacity for it. I don't know. I think the one that I asked you about was here, Chester, though. Because look at that. Chester gave up 25, 5, 10, 15, you know, 16 or so percent of the market in the size category. Okay, so I think your assignment's going to be a typical one that we've done, but walk through it, okay? Go through it like I just showed you and tell me what they gave up. We'll look at the assignment and come back. Okay, and I think I'm asking you, I think when we do that too, maybe to take that next step and tell me about profit. In this case, I think for Chester, the plus for you guys is you're just going to have one product. You know, when I was dealing with Digby last time, there was the two products, and I even confused myself, but you guys will just have the one product, so it should be not too difficult. This is kind of, you know, my hope is at the end of the competitive rounds, I'm not so confused. Because when I look at the perceptual map, I say, you know, I can tell what Ferris is doing, okay? They're a high end. It looks like they're letting their low-end traditional products just fade out to the bottom. That's great. So they're a high-end differentiator niche, right? Boom, that's what Ferris is. I can tell you what Erie's doing, right? Because they got all their products in the low-end traditional. That's it, period. They're a low-end niche. So I got high-end niche, low-end niche, okay? I can kind of tell you what Chester's doing. They're high-end. It looks like they're maintaining, but they're letting cedar go. They're kind of maintaining their traditional. That's fine. I would still say they're probably a high-end niche. Okay. Now I get to the other ones. I got to admit, between Digby and the Baldwin and Andrews, I don't have a clue. Okay. And I might have taken some points off on the strategy because I don't have a clue where you guys are at, but it didn't matter because you weren't winning anyway. So there wasn't any sense in taking points off for that. But you know, and when I look at the perceptual map, you know, we've got aft way out here in no man's land. We've got a couple here, both, what is it, Buddy and the Gape, or Agape, or whatever it's called. They're kind of out here in no man's land, Ball and Bead, you know. Yeah, this is telling, you know, when you look at the perceptual map, and you can kind of see we've got some products that are in a little bit of an oddball position, so.
When you're trying to get rid of a product, when you're in the R&D, you just take the performance and size and just totally. You can't put 0, I guess, but
you don't do anything. You don't have to. If you're letting a product like let's say Buddy, and you're just going to get rid of it, you've let it drift out of, this is the performance category here. No, this is the size category here. So you've let Buddy just drift out, right? You know, the proper way then to do that is, you know that as it goes backward like this, the sales demand's going to go down, but you might still sell a few, right? So you don't spend a lot of money on R&D. You don't spend any money on R&D probably. You probably lower your price a little bit, okay? And you just try to sell a few. You also sell capacity as it goes.
okay.
You know, why wouldn't you sell 100 units of capacity maybe every round? Maybe a couple hundred. Maybe you sell a couple hundred at the beginning and then 50 per round, you know, for the next, until you get towards the end. And you got to remember, when you ultimately get rid of it, if you've got some inventory, you want to go down to 1 and then 0. Okay. If you don't have any inventory, then it doesn't matter. You can just sell sell whatever capacity you have left. But yeah. And it makes a lot of sense. I mean, if you're gonna, you know, we start with all kinds of capacity, right? We start with so much excess capacity in every deal. If you know that that's your strategy, it might make some sense to sell some of that capacity. You know, if your capacity here is 600, okay, and you're only going to sell 600, you think, in the first round, which is probably that's probably pretty aggressive. God, sell 300 units of capacity, right? And you could still make 600 units then, right? Because you'd still have 300 units of capacity. And you can make double, okay? And then you invest that into the things that fit your strategy, right? If you're Ferris, you're investing that in the R&D and stuff that it takes then to get these products up to snuff. You're investing it in new products. You're investing it in all kinds of other things, right? And so, again, know what your strategy is at the start, and then when I say boldly go after it, those are some things that, to me, those are even mildly bold. But, yeah, if you know that you're going to exit some segments, get started on it. Use that money for other things. Okay? Get going right off the bat. If you're Erie, right, and you've got products, they're getting rid of these products, they're letting some of them float down. My guess is they were selling capacity right off the get-go in the size and performance. They might have brought one of these over into the traditional, I'm not sure. Okay, their high end ended up being down in the traditional, and one of these might have come over into the traditional. But whichever one they were selling, I'm sure that they were getting rid of it and just investing that for them. If you're low end, then you're investing it in automation, HR, other things to lower your costs, right? Started to see some huge, improvements here. Look at that. Baldwin did get up to 13%. Chester probably helped out their cost quite a bit by being 10%. Roughly 9%, I'm sorry, on their HR savings. Huge deal. You guys will have wage negotiations in the 6th round. Excuse me. Digby, look at that. Last round and last practice round, and yet they were bold. I'll give them that. And you can see what a difference, this investment made. Chester made none, so I would.
That goes towards the profit margin.
Oh yeah. So a question could be, and I don't know for sure what the answer is. I'd have to get my pencil out. But Digby invested a lot of money both in plant improvements. Okay, keep in mind that that's just an asset for an asset trade, although it did increase their depreciation slightly. But they invested a lot of money here in TQM. On an after-tax basis, would it have been enough to make them kind of competitive with Chester? Maybe. Again, though you got to remember that they're a much bigger company, so for ROE and earnings per share, they got so many more shares outstanding, and they've got they're such a huge company that, even so, I mean, had Chester matched them here, they still would have kicked butt in ROE and earnings per share. I mean, it wouldn't even been close. It wasn't close as it was. Okay. But you can start to see it's kind of important to take a look, and you can really see where that investments. Look at that, 11% and 11% material. And their total cost, variable costs, were $111 million, and they saved 10% on those. So they saved $10 or $11 million, right? And they'll save that for the next 3 rounds. So a huge deal, huge. Okay, the money that you save. Because you also got to remember that you're investing this, you're saving 10%. 10% this year is small compared to next year and the year after, because these industries are growing at 14%, right? So the compounding effect here is just huge, and it's dramatic. Okay, we better take a look at next week's assignment. See if I gave away any answers I might have already. Chester and Digby, I told you this one, had very similar sales, roughly identical, right? But Digby had a much higher contribution margin. In spite of the higher contribution margin, Chester ended up with a profit nearly twice as large as Digby, right? We saw about what I said, $36 million flop or something like that. Okay, why? How'd that happen? Okay, 2, Chester left a bunch of money on the table in the size segment. How much in terms of sales and before tax profits? That's why I walked through that one kind of painstakingly earlier, right? So go get the actual percentages. Don't just look at the graph. Go get the actual percentages from the deal. Take it times the demand, right? And then go figure your marginal costs. Why did Ebb have the highest overall contribution margin? Please give me more information than price relative to variable costs. So sometimes I've asked this question and people say, well, because their price was higher and their costs were lower. Well, that's the definition of contribution margin, so I don't want the definition of contribution margin. I want you to get in there and specifically tell me, was Ebb's price higher? Maybe, that would be one, okay? And again, look at how I answered the other one, right? I said there's two things, there's price and there's variable cost. So price up here, boom, was it higher? Maybe, maybe not. And then variable cost, you got labor and material. Go look at both of those and tell me, okay? And you can tell me even why, their labor cost was less because. That's great, more information, right? Why did Chester have a negative expense? I did that for number 4. Yeah, why did Chester have a negative expense for other fees, write-offs, TQM, and bonuses? Okay, that one might be kind of a bonus type of a question because you gotta kind of know some things. Although McKell kind of gave it away if you guys were listening, so hopefully you weren't. And she doesn't have to answer the questions. Okay, any questions? Questions about the round? Questions about starting over? Questions about the assignment or assignments? Okay. I will see you all on Tuesday for decision day, round 1, competitive round 1 decision day. Is this starting to make sense? The whole game and stuff, you're starting to kind of get the hang of it a little bit, and good.
So, are we able to access this round 5 later?
You should be able to.
Okay.
Yeah, as far as I know, the reports will stay available. I think as we start into the competitive rounds, like you'll do competitive round 1 and the practice round 1, Capstone Courier might go away, but 5 should be there. If something happens and you can't, let me know, because I know I can access it and I could do it PDF and send it out.
Okay.
So in a worst case, I'm sure I can access it and get the PDF, but you should be able to as far as I know. Okay.